the United States is sitting on a $36.5 trillion debt bomb, a figure so massive it actually surpasses the combined economic output of China, Japan, and Germany. But this isn't just a jaw-dropping statistic. It's a glaring warning sign of a system in crisis, one that could unravel the dollar's 80-year reign as the world's reserve currency and shake the foundations of the global economy. From Nixon's economic gamble in 1971 to the escalating trade wars of today, this is the story of how America's financial dominance is eroding, and what that means for your wallet, your savings, and your future. Wall Street analysts spend their days obsessing over quarterly earnings, market swings, and the latest IPOs. But the real threat to your financial security isn't a sudden stock market crash. It's a seismic shift in the global economic order. This shift is already underway, as nations from Europe to Asia quietly reduce their reliance on the dollar and ramp up their gold reserves. The world is preparing for a new era, and the U.S. is at risk of being left behind. Let's rewind to 1971. President Nixon made a fateful decision. He severed the dollar's link to gold, abruptly ending the Bretton Woods system that had anchored global finance since World War II. Overnight, the dollar was transformed into a fiat currency, backed only by the promises of the U.S. government. While this move temporarily boosted America's spending power and global influence, it also unleashed a series of hidden costs that have been building ever since. First cost, debt addiction. Without the discipline of gold, U.S. debt exploded from just 35% of GDP in 1971 to a staggering 124% today. The second, global distrust. Foreign governments now hold $8.7 trillion in U.S. debt, but major holders like China and Japan are rapidly diversifying into gold and other assets, signaling their waning confidence in the dollar. The Nixon shock wasn't a solution. It was a ticking time bomb, and now the clock is almost out. To slow the debt spiral, the U.S. has turned to tariffs as a last-ditch lifeline. President Trump's 34% tariffs on Chinese goods and 25% on EU steel set off a chain reaction. Retaliation. The EU hit back with 26 billion euros in counter-tariffs, while China banned exports of rare earth minerals vital for U.S. tech and defense. Domestic fallout. American consumers are now paying 15 to 20% more for everyday essentials, from electronics to groceries, as companies pass higher import costs down the line. These tariffs amount to a $1.2 trillion tax on Americans, but policymakers see them as the only tool left to delay a full-blown debt reckoning. While Washington wages trade wars, a quieter but more dangerous crisis is unfolding. Foreign investors are fleeing U.S. debt. Japan, America's largest creditor, sold off $200 billion in treasuries just last quarter, a sign that faith in the dollar is rapidly eroding. As trust in the dollar fades, gold has skyrocketed, up 27% in just 6 months, now topping $3,356 per ounce. Why this rush to gold? Central banks. China alone added 225 tons of gold in 2024, part of a global push to de-dollarize and reduce exposure to U.S. risk. Retail investors, gold ETF purchases hit a record $50 billion in the first quarter of 2025, as inflation consistently outpaces interest rates and erodes the value of cash. Gold isn't just a commodity anymore. It's a global vote of no confidence in the dollar and the U.S. government's ability to manage its finances. The U.S. government now spends 14% of its entire budget just on interest payments, more than it allocates to defense or education. To keep the system afloat, policymakers face two grim and politically toxic choices: austerity/Social Security, Medicare, and other social programs, risking widespread unrest and political upheaval. Hyperinflation, print money to devalue the debt, which would wipe out savings and devastate the middle class. Neither path is sustainable, but time is running out. At the current pace, U.S. debt will hit $37 trillion by September 2025, pushing the country even closer to a fiscal breaking point. But the real existential threat isn't a technical default. It's a world where the dollar is no longer the king of currencies. China and Russia are leading efforts to create a gold-backed trade currency, designed to bypass the dollar entirely. And there are early signs this strategy is gaining traction. Oil deals. Saudi Arabia now accepts Chinese yuan for 12% of its oil sales, a historic break from the petrodollar system. Debt dumps. Brazil and India slashed their U.S. Treasury holdings by 18% in 2024, accelerating the move away from dollar-based reserves. If this new coalition succeeds, the dollar could lose 30% of its value almost overnight, triggering a global financial earthquake. Some economists are calling for a complete reset of the global monetary system, potentially tying currencies to a basket of commodities and digital assets. But without decisive U.S. leadership, the world risks descending into monetary fragmentation and chaos. The 2020s are starting to look eerily similar to the 1970s. Surging inflation, energy crises, and a looming currency collapse. So how can you protect yourself? Diversify. Consider allocating 10 to 15% of your portfolio to physical gold or gold ETFs as a hedge. Watch the East. Chinese firms like BYD are dominating the green tech revolution. Look for ETFs with exposure to emerging markets and innovative sectors. Prepare for volatility. The dollar's decline will create both chaos and opportunity for those who are ready. America's debt addiction can't last forever. The only question is, will you be prepared when the bill finally comes due?